What's going on, my fellow wealth creators? Matty Ice here. Welcome to the final part of this series, part 3, where we are breaking down an article by the website called The Wealthy Accountant, talking about the infinite banking concept. There's a lot of misconceptions, a lot of misunderstandings, a lot of misleading half-truths, unfortunately. At the end of the day, again, like I mentioned in the other videos, I think this is productive to hear both sides of the story, but a lot of times only half of the story is being told. That's why I wanted to do this video. And I was able to get an ad blocker, so I think we had a little bit of lag. I don't think it was too bad on the other videos, but it was slowing my computer down pretty good. So got the ad blocker. We're good to go. And I want to finish up the article here, talking about basically where we left off or finished up on the last videos. I was explaining what happens to the cash value when you pass away. That it's really good stuff. If you haven't watched part 2, I'll link all parts of the series down below. Make sure you watch that. It's really important. So anyways, I'm just going to pick up where we left off. Remember when I mentioned the loan from your cash value that comes from the life insurance company's general fund? Yep. Well, that is because the cash value belongs to the insurance company. I addressed that in part 2. I just don't think that's very useful. I mean, you could argue, I guess, that the equity in your home is owned by the bank. Who owns it? I don't know. My thing is, how difficult is it to access? Do we have control of it? That's really what's important to me, anyways. So, that is, let's see, belongs to the life insurance company. You have a right to borrow from this cash value, just like you have a right to borrow from the equity in your home. But make no mistake, all that cash value belongs to the insurance company, not you. Well, I'm not 100% sure what the point is that he's trying to make here. The insurance company has a contractual obligation to loan you money under certain terms outlined in the policy until you die. That's true. In the screenshot above, you can see that if you died in year 23 of the policy at age 63 in the projection, your beneficiaries would receive $1.6 million in death benefit. Let's just confirm that here. Age 63. Yep, 1.6 million. This is the death benefit column. So, yep, $1.6 million death benefit. Okay. The cash value stays with the insurance company, properly structured for infinite banking or not. I discussed this in part 2, at the end of part 2 in this series. This is just very, very misleading because it makes it sound like it's some kind of evil life insurance company that is screwing you over and stealing your money or something like that. It's just ridiculous. The cash value, guys, just to recap it really quick. Cash value is the equity that you have in your life insurance contract, just like you have equity in your home that you can borrow against and use for emergencies, wealth building opportunities, etc. And it also represents how much you would receive from the life insurance company if you canceled or surrendered the policy. Just like your equity in a home, if you were to sell the home, that's what you would receive for the home. Except life insurance is far better in this example because your cash value blossoms into the death benefit when you pass away. And the calculation for that is cash value plus net amount at risk equals the death benefit. I talked about that in part 2. That's how you can calculate the death benefit and argue that your beneficiaries actually kind of get the cash value. And using the example from the previous video, I have $1 million in death benefit, $500,000 in cash value. What's the net amount at risk there to the life insurance company? It's $500,000. 1 million minus 500,000 is $500,000. So when you pass away, you look at the cash value. Okay, I have $500,000 in cash value. We're going to give that to the beneficiaries. Plus, on top of that, we're going to add another $500,000 to meet our death benefit obligation. Now, again, I don't think that's technically how it works. You won't see that in a contract because the life insurance company doesn't overcomplicate this like we are. They just write a check for the death benefit. That's it. But to just kind of debunk this myth about the life insurance company stealing your money, that's just ridiculous. All right, so I could go on, but you get the point. No, we don't, because your point is completely inaccurate. There are many fatal flaws. He didn't actually really talk about any fatal flaws to the infinite banking concept at all, at least that I could see, that wasn't at least very easily debunked and addressed. Life insurance companies and insurance agents love the concept and have ample reason to be blind to the fatal flaws. Well, I just destroyed all of these so-called fatal flaws. I think I did anyways. I mean, because once you understand how these things work, just kind of a no-brainer. These things, also when you understand how these things work, these kind of statements just don't make sense. So in the end, there are only a few reasons for using permanent life insurance, and infinite banking is not one of them. It absolutely is one of them. Infinite banking is incredibly powerful when you set up a custom designed dividend paying whole life insurance policy. I have 2 of them, guys. They are just awesome. You just get so many benefits from them. One of them being able to implement the powerful strategy known as infinite banking, no matter how properly strong. Okay, whatever. I am curious to see what these alternatives are. The first infinite banking alternative is only available to certain people. People with debt or a mortgage works best. This in no ways means you need to go into debt so you can use this strategy. So if you're not in debt, you can't. You don't have to go into debt to set up an infinite banking, dividend paying whole life insurance policy. So that's kind of funny. The next strategy, let's see, is the next strategy is a variation of this strategy where no debt is necessary. The only reason why I start with this strategy is because it can generate a larger return for some people and also helps you get out of debt faster. The infinite banking concept can be a fantastic way to eliminate debt, really like much faster than if you were just making regular payments on it. Here's how the strategy works. You need a mortgage or line of credit. You have a portion of your regular mortgage to the line of credit. Your regular mortgage is now paid down a bit more than it would have been. Instead of keeping more than a token amount in your checking account to pay bills, you will drop the money into a line of credit. Blah blah blah. Yep. Now you now pay no interest since that amount. You basically paid it back. That amount is no longer borrowed. I mean, you technically could do that with a policy. I don't recommend it, but when you need money to pay bills, you can transfer money from the line of credit back to your checking account. Your rate of return on your everyday float is the rate of interest on the mortgage. I mean, look, can you do that? Sure. I'm not going to say you can't do something like that. Why would you though, if there's a far more efficient way to do these types of things with dividend paying, where you get so many more benefits? That's my question. If your line of credit has a higher interest rate than your mortgage, the strategy runs into problems. Okay, so how about maybe fatal flaws? We could call it, but whatever. I'm being a little cheeky, I guess. When interest rates were very low for a decade, this strategy worked better. All right, you guys can go through the strategy. I'm not a fan of this kind of stuff, to be honest. I'm not saying it can't be beneficial, but I personally know the power of infinite banking, and it'll run circles around stuff like this, in my opinion, for the most part. Let's see. The second infinite banking alternative anyone can use. Infinite banking, as promoted by insurance agents, is designed as a big savings account you can borrow from. Your original money keeps earning even when borrowed. That's correct. When you borrow, the funds are invested in income-producing assets. We already talked about that in, I believe it was video 1, the so-called double dip. I mean, yeah, you're technically making money twice, guys, and it gets more and more efficient, more and more profitable with each year, because that's what these policies do. They get more efficient. So when I borrow from my policy to flip a piece of equipment, do a private money loan, those are my wealth building strategies right now. Okay. Let's keep this simple. If I borrow from my policy, let's say I borrow $100,000 at 5.5%, but then I lend that out at 12% plus points. Does that make sense? Like, that's a pretty good spread. That's what banks do on a regular basis. But while I was doing that, my policy continued to get that 3 to 5% uninterrupted compound growth, tax-free. Okay. So I essentially did double dip. I made money twice. The only cost to do that was the simple interest that I paid. And each year, and using that same exact scenario, if I were to do that every single year, that's the profit, like how much my wealth would grow by every year using that same scenario every year would increase every single year, because my policy is getting more efficient. So that 3 to 5% growth that I'm getting, that's getting more and more efficient every single year. Plus, I'm doing the 12% plus points over here. And my only cost of doing that is the simple interest. And I showed you in, I think it was part 2. I showed you the difference between compound and simple interest, and why it is absolutely worth it to pay simple interest in order to get uninterrupted compound interest. And you could even pay twice the interest rate on the loan than you're earning in compound interest and still come out ahead. That's how powerful compound interest is, guys. So anyways, moving on. Let's see, as we saw above, the insurance company is not the warm, fuzzy entity. Look, like, what? Why are you saying free money? Like, I got a problem with this. I don't like this. Nobody's, at least I haven't seen it. If agents are out there talking about like free money, then that's obviously not good. But I haven't seen a lot of that with the infinite banking concept. I certainly have never said that you're going to get free money. I mean, all you're doing is putting your money into a policy. It's going to get tax-free compound growth. You're putting your money to work. You're putting your money in a place that's going to give you a ton of benefits. That's all that's happened. No one's giving away free money, though. That's just how this strategy works. Your money's still growing because you are paying interest on the loan. No, dude, your money, the cash value in your policy would grow whether or not you borrow against it. Like, that's what that's what the policies do, guys. You have a guaranteed growth rate, interest rate, and then you get dividends on top of that. You could never take a policy loan out, and your policy would grow every single year. That's what it's designed to do. Paying the interest on the loan has nothing to do with the growth of the policy. The policy is just going to do what it does. We're paying interest to make sure we get that uninterrupted compound growth while we build wealth in other ways. If you eliminate the insurance company, invest the same monies, you will have more because you don't have the middleman to pay. I don't like these kind of statements because they're basically suggesting that you shouldn't save money. Because if all that matters is rate of return, then why would anybody ever put money in a savings account? Why would savings? Because historically, like savings accounts, they don't pay very good interest rates. So if that's the case, then why not just dump all your money in the market where you're going to get the highest rate of return potential, right? Like, I don't like statements like this. We're saving money just in a different way. These whole life insurance policies are very, very efficient savings vehicles. So we could save, which we should do, and then we make investments, whatever that is. And we just happen to use our policy in order to make those investments. I don't see why that's such an issue. Let's see. With this in mind, Treasury Direct is an excellent tool for building wealth with excess funds. I would agree with this. I wouldn't say it's an excellent tool. I'm actually not a fan of government debt. But right now, at the time, I have a good amount of money in Treasury bills right now because they're paying really good interest rates. I am slowly moving that. Basically, I've got a large portion of my money in Treasury bills. Eventually, that money is going to be used to make my premium payments. I'm going to transition that money over into my life insurance policy, depending on what interest rates do or whatnot. But Treasury Direct is a great place to buy Treasury bill, like short-term, he's talking about right here, short-term Treasury bills directly from the U.S. Treasury. There's no middleman. It's pretty easy. You just create an account, select the Treasury bill that you want to purchase, and for how long you can do 4 weeks, 8 weeks, like all the way up to a year, I think. So it is a good place to store money. Maybe not store money, but put some money in, get a good rate of return, a pretty decent rate of return. So definitely something to look at. The concept works with money market accounts at financial institutions. Right here is the magic. Is he saying that this is an infinite? I don't think he's saying that this is an infinite banking strategy. Here's the magic of infinite banking. When you borrow your own money, you also pay. Nope. That is how the insurance company gets you to believe you are magically growing your wealth, even while money. Nope. This is actually. I agree with it sounds like he has an issue with this. Like it's not true, and he's actually right. You don't pay yourself an interest rate. Like when I borrow from my policy for my car, for example, I set an amortization schedule, and I pay like the interest that I pay to pay that loan back. I set at what I would have been approved for had I used a traditional loan from the bank. So if that's 6%, then I would set an amortization schedule to pay that loan back at 6%. I think I do like 10% or whatever. But the interest rate, whatever you decide to pay yourself, you pay yourself back. You're not actually paying yourself interest. The interest is not growing your policy. That interest is going to the life insurance company. Now, if you charge yourself a higher interest rate on your amortization schedule, like to pay the policy loan back, then you're just going to pay the loan back faster. That's it. And you'll pay less interest because it's simple interest. But you're not paying yourself interest. That does not help your policy grow. It just helps you pay the loan back faster. And you can use that cash value again to invest in other things. So, but yeah, I do agree. Like I have heard people talking about infinite banking, like paying yourself interest and stuff. I do think that is pretty misleading. That does need to be addressed. So I do appreciate that. In a nutshell, this is the sinking fund. You pay interest as if it were a loan. Yeah, but you don't get any of the benefits of that you get with dividend paying whole life insurance inside of a savings account. It's just not a really good comparison. Your money is sitting there doing nothing. Maybe it earns a little bit of interest, that's about it. And then when you use the money, it's no longer earning that interest versus That's not the case with whole life insurance. You get that uninterrupted compound growth plus all the other benefits. Like I don't see how that's a really good comparison. They want you to think it's only available for them, but it is such a simple concept. Anyone can do it, and insurance has nothing to do with its structure or not. Okay. Then he goes into what if I need life insurance? I'm not going to get into that. So we'll go ahead and wrap up. All right. So that was fun for me. I love talking about this stuff. I love breaking these ideas down and sharing the other side of the story for you guys. This is the journey that I went on. And that's why I started my channel, where I was just like, I was consuming so much content, trying to listen to both sides to see what made sense for me. And I'm really glad that I did that, because, I mean, we're talking about major financial decisions here that have lifetime consequences, potentially life-changing consequences. So we want to make sure we take our time, do our research, understand how these things work so that we can decide whether or not it makes sense for us. And once you do, if it does make sense for you, it does tend to become a no-brainer. That's what happened with me. But I definitely did a lot of research first, guys, learning how these things work. So I do hope this has helped you a little bit along your journey, whether to decide if this is a good fit for you or not. If you want to have a conversation with myself or my team, I will have a link down below in the description to my calendar. Feel free to book a call if you would like to discuss this. All right. I hope you guys are crushing it. I will talk to you in the next one. To your success. Matty Ice is out.